It's Friday, 22nd of November, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, what an end to the war in Ukraine could mean for economies in the conflict and on its periphery. But first, Neil Shearing, Greek chief economist, joins me to walk through the key issues in macro and markets at the end of another week's trading. Hi there, Neil.
Hi, David.
We've set ourselves a challenge this week, haven't we? We're not going to mention the president-elect.
No mention of Trump this week. We've written enough about Trump. We've talked about Trump and have fallen at the first hurdle.
There you go. Well, God knows we've spent long enough talking about the election, and we will be doing so undoubtedly for the coming months and years. And actually, your weekly note has been a big help here because you put it out every Monday, and I've been reading this week's draft, and its jumping off point is that there is actually a lot going on in the world that isn't related to what's happening in DC. One of the things it focuses on is what's been happening with inflation. We've had UK, European, US inflation data in recent weeks, and they haven't been particularly comforting, have they? So what's been going on there?
Yes, indeed. I think if you look across, actually, it's not just Europe and the US. If you look across both developed markets and emerging economies, the common theme over the past month or so has been that the inflation data have started to surprise on the upside. So in the Eurozone, inflation picked up back to its 2% target. In the UK, it's gone back above its 2% target. In the US, we had a third consecutive month of 0.3% month-on-month increase in core prices on the CPI measure. In the coming week, we'll get PCE inflation data. We think there'll be about a 0.3% month-on-month increase in core PCE in October. Japan, India, Australia, we've had surprises on the upside to inflation in all of these countries. So what's going on? I think some of it is one-off. So if you look at what's pushed up inflation in the UK, for example, a lot of that has to do with increases in regulated energy prices. Core inflation measures or services inflation's picked up across Europe, but that seems to be due to some unusually strong increases in transport prices. Don't think those will be sustained. Indeed, they may even be reversed. In the US, there seems to have been some unusually strong increases in motor vehicle prices that's contributed to a rising in core inflation. But the real concern, I think, when it comes to the US has been that we've had unit labor cost data released just after the election. So it flew under the radar a bit. And that showed that unit labor costs in the US were actually revised higher, 3.4% year on year in the third quarter of this year. Now, that's completely inconsistent with the 2% inflation target. If you're a Fed official and you want to make the case for inflation returning to 2%, then you really need unit labor costs growing at a similar pace. Clearly 3.4%, way above 2%. So it's the US, I think, where we had the greatest concerns about the pickup in inflation over the past couple of months. And of course, without wanting to mention Trump, as we've talked about on this podcast, a common thread running through a lot of his policies and proposals for government is that they risk higher inflation. So it's the US, I think, amongst all the developed markets where we have the greatest inflation concerns.
The Economist team is doing a lot of thinking now in terms of what 2025 is going to bring. Obviously, the policy outlook is going to be pretty central to all of that. How does, given all of what you've said, how does that feed into what we're expecting with interest rates into the end of this year and into 2025?
I think at this stage, I still don't think it's enough to prevent central banks from easing policy further, from cutting interest rates further. I think they'll take a more gradual approach. So in the UK, we had already pushed up our profile for interest rates following the autumn budget, where fiscal policy was loosened a bit more than we expected. So we've raised our profile for interest rates there. In the US, we've pushed up our profile for the Fed funds in anticipation of potential inflationary measures under a Trump presidency, things like tariffs, possibly immigration reform too. So we've already pushed up our profile for interest rates. I don't think it's going to stop central banks from easing policy further. I just think they're going to move at a slower pace. And in the case of the US and the UK, finish at a higher level than was otherwise the case. So for example, in the US, we now see interest rates troughing at 3.5 to 3.75. And in the UK, we've got them troughing at about 3.5 too.
Staying on policy, but moving to China, because that's another feature in this note of all that's going on in the world that's not related to the next US president. It is amazing, though, isn't it, how stimulus talk has been pushed off the front pages since the election outcome. We're nearly 2 months after that first China stimulus announcement. Since then, what's amounted to a string of disappointments really for the market. What's gone wrong with the whole China stimulus story?
First, the facts. What have we had? We've had some modest cuts in interest rates, and we've had some instruction from central government to local government to spend money that they've raised through bond issuance by the end of this year. And we've had some financing support for local governments too from central government. So that's the totality of what we've had. And obviously, as you say, it falls well short of what had been mooted and trailed on some of the news wires. Now, one theory doing the rounds is that the wheels of China's government move slowly. The leadership is still putting together a plan. The details of this plan will be forthcoming, and we'll learn about it in due course. That's perfectly possible. However, an alternative take, and one that we find more convincing, is actually that the leadership has reached a similar conclusion to us, really, which is that the economy is not really in desperate need of policy support of either monetary or fiscal. If you look at economic growth in China, it's substantially weaker than has been the case over the past decade. It's about 4.5% on our China activity proxy measure in a year-on-year basis. That doesn't seem to reflect a weakness of demand, of aggregate demand that can be addressed and remedied through looser fiscal and monetary policy. Rather, it's about structural issues that are weighing on Chinese growth, and particularly issues on the supply side of the economy. And policy support doesn't help to remedy that. If you look at unemployment, there's no real evidence of that the unemployment's picking up in a meaningful way. So it doesn't seem to us that the problem in China is weakness of demand. It's more structural issues on the supply side. You've got to remedy that through and address that through reform. And that reform's not been forthcoming either. But I think when you look at the growth performance of China's economy and what's underlying that, it doesn't really, to us, scream of an economy that's in desperate need of monetary and fiscal support, which is why I think we've probably not got it.
Yeah, it's these market expectations, like Charlie Brown and Lucy with the football. She sets the football up, he runs up, she pulls it away, he winds up on his back every time. And every time there's an announcement of a government press conference, the market gets excited about stimulus and there's disappointed. But actually, to your point about the government still putting this plan together, there is this idea in the market, isn't there, that the government's holding back stimulus in reserve in expectation of a new trade war in 2025. And I know you've had this question directly in some of your client meetings over the past couple of weeks. What's your take on this?
Again, it's possible, but I think that slightly dodges the question as to why there's not been stimulus now, right? If you thought that the economy was in need of immediate policy support because economic growth was slowing, unemployment was rising, and the remedy to this was looser monetary and fiscal policy, then you wouldn't hold that back in anticipation of the fact that the economy might be even more in need of policy support next year. That's not a reason for delaying policy support. The fear that more adverse economic conditions might be coming down the track as a reason for doing more later, not for delaying support in the here and now. So I don't think it helps to explain why we've not seen policy support today. There is a question as to how China would respond to additional tariffs placed upon US imports from China, and indeed efforts to clamp down on rerouting of Chinese exports through third-party countries. We look back at the lessons from the first Trump administration. Every country, with the exception of Japan, actually retaliated in some form to the threat or the actual imposition of tariffs by the first Trump administration, but they did so in a pretty modest way. They did so in a way that was calibrated so as not to escalate the situation. So we're talking about targeted tariffs on politically sensitive sectors of the US economy, and they let their currencies adjust. And I think China would probably follow a similar playbook this time around. Modest taxes and tariffs on imports from politically sensitive parts of the US economy, allow the renminbi to weaken. Maybe we get some fiscal offset and some additional support for Chinese exporters from central government too. But like I say, I think they'll cross that bridge when they come to it. I don't think the reason that we've not had policy stimulus today, policy support today, is in anticipation of the fact that it might be needed tomorrow. I don't think that makes any economic sense.
All right, I'm going to move on before we really do start talking about Donald Trump and the next presidency and really shatter our vow. Next Saturday is the second anniversary of the launch of ChatGPT. And I guess if you could pin down the start of all of this AI hype to one day, it really is November 30th, 2022, isn't it? We had Nvidia earnings this past week. That's the poster child of this AI arms race. And I have to stress, we don't cover individual companies, but these earnings reports are important signals, aren't they, about the macro and market impacts of AI. So what does the latest one say about our forecast, about how AI is going to transform the global economy?
You're right. Yes, we don't cover individual stocks or securities, but it was striking, I think, and it was striking for a couple of reasons. Principally, it was the lukewarm response in markets, I think, that I found most interesting. And that was all the more interesting and significant because actually the earnings report was pretty good. It showed extremely large increases in both revenues and profits. So partly that's a reminder, serves as a reminder of the extent to which expectations around some of these big tech companies have inflated. But I think the actual performance of the big tech companies underlines the fact that there is growing demand for AI and AI-related products. This is a really different environment from, say, the dot-com bubble in the early 2000s, where actually a number of those companies were actually not making much money. There was not much revenue. There was certainly no profits. The tech companies that are at the vanguard of the AI revolution generate high revenues, high amounts of cash, and large profits. And that's a very different position from the situation in the early 2000s. Now, none of that's to say that a bubble is not inflating in tech stocks around AI. We think that it is. We've talked about that before. I suspect that will drive the S&P 500 even higher over the next year or so as that bubble continues to inflate. Eventually, as all bubbles do, that will pop. But the performance of these firms and the fact that they're generating so much revenue and the fact there's so much demand for these products is an illustration of the fact that the rollout of AI products and technology is continuing. And that will continue to, I think, to have economic consequences long after this bubble around technology and financial sectors bursts and dissipates. After all, the dot-com bubble burst, the internet didn't disappear. I think the same thing's going to be true around AI. So a slightly lukewarm response to these results in markets, but I'm still pretty confident that what's happening under the surface is rollout of AI continuing, and this will generate substantially positive economic consequences, not necessarily in the near term, but I think the effects will be significant and positive over the long term, and that's certainly a view that we've embedded in our long-run forecasts.
But we're talking $1 trillion worth of investment here. I mean, are we seeing any of the benefits of this investment in AI yet?
Not necessarily in the productivity numbers. If you dig deep enough into beneath the surface of some of the US numbers, you can see investment in software, for example, picking up. It was possible earlier in the year, for example, to see investment in software picking up, and I think that might be the first sign of AI having an impact in the macro data. But don't forget that there's Robert Solow's famous comments in the mid-80s about the computer age being everywhere apart from in the productivity statistics. And then by the mid-90s, productivity growth had started to pick up. And I think the same thing is playing out here. It just takes time. So we've baked in an increase in US productivity growth of about 1 percentage point a year from AI, but only by the end of this decade. So it's going to take some time to come through.
Neil Shearing there on AI's potential, Chinese stimulus, and what's worrying and what's not about recent inflation releases. I counted 8 instances where we mentioned Donald Trump's name, despite our vow not to talk about the president-elect for 1 week at least. You can't really avoid it when you're talking about the global outlook. The Economist team is preparing its 2025 look ahead, and if you're in London on the 4th of December, they will be holding a panel discussion all about that. It's a great chance to meet the team, to get your questions answered, and to do a bit of networking. I will add registration details about that event to the podcast notes. We will, of course, be tracking those US and European inflation releases in the coming week, and you can track that data and our forecast via our US and Europe macro dashboards. We've got more than 30 interactive dashboards covering economies at country and region level, and they come with options to download all of the data and plug it directly into your workflow. I will add our data page to the podcast notes so you can learn more about how these capabilities can help you. Now, one potentially major shift to expect after Trump is inaugurated on January 20th is US policy towards the war in Ukraine. Donald Trump said on the campaign trail that he would end the war in 1 day. And speculation about an end to fighting has been building since he won the election earlier this month. At the same time, facts on the ground have been changing in recent days, with Ukraine firing long-range US and UK missiles at military targets in Russia for the first time, Russia firing a new kind of ballistic missile at Ukraine, and Vladimir Putin stepping up his bellicose language. To find out whether an end to fighting is possible, what it would look like, and the economic implications of that, I spoke to senior EM economist Liam Peach earlier this week. And I started by asking about the potential endgame of this conflict.
So I think there are a lot of moving parts to this, and it's of course highly uncertain. We've previously argued that neither side has made significant progress on the battlefield in the past year, and that the war would become a frozen conflict, potentially lasting many years. I think a Trump presidency certainly does open up more scenarios, and one of the most frequent questions we've received by clients recently is just about how the war now develops under Trump. We know that Trump has been a vocal critic of US military and financial support to Ukraine, and that he would likely aim to reduce this support as US president. I think it is unlikely that Trump would simply abandon Ukraine, but we do now see it as more likely that US will pare back funding as part of some kind of negotiated settlement under Trump. Trump could limit the flow of aid and weapons to Ukraine to put pressure on President Zelensky to agree to a ceasefire, probably involving some loss of territory to Russia. But even this is uncertain, and it's not clear if Ukraine or its European allies would be willing to go along with this. European countries would undoubtedly be concerned if Russia's sphere of influence moves close to the NATO border. I think there's also a broader question about whether Trump could successfully get European countries to take on more of the financial burden, which could prolong the war for longer. So, in short, I think hopes of an end to the conflict have, on balance, increased, but I think it's likely this takes longer to arrive than many currently hope.
When it does finally happen, what do you think the shape of this agreement will be? Because it does sound like we're not talking about a lasting peace deal, more an end to the fighting, as you suggest. Start with Russia. When the war started, there were these sanctions were imposed on Russia. It was effectively frozen out of the Western financial system, directly at least. What would an agreement to end the fighting mean in terms of the sanctions, in terms of Russia's presence within the Western financial system?
Yeah, I think an end to the war will impact Russia's outlook in two important ways. I think the first, as you mentioned, is on sanctions and possible sanctions relief. And I think the second is if there's a cutback in Russian military spending. So I think it's likely that Russia would demand an easing of sanctions as part of any ceasefire talks. I think Russia would most likely want its assets in the West to be unfrozen and to get relief on access to the Western financial system and dollar transactions. I think this one in particular is an area Russia has struggled to adapt. And I think it explains why Russia has been pushing particularly hard for de-dollarization and to develop an alternative clearing system within BRICS members. I think the West might be prepared to lift sanctions in some areas, such as on Russia's trade and financial flows with third countries. But in general, I think hopes for a major rolling back of sanctions on Russia's energy and financial sector will be disappointed. And there's also a question here, I think, that if Russia really wants sanctions rolled back, what kind of concessions, if any, would it have to make, particularly on territorial claims on Ukraine? Russia has already adapted well to most sanctions. It's rerouted its oil exports from the west to the east. Sanctions relief is unlikely, in my view, to be a game changer for the outlook as far as Russia is concerned. I think an end to the war that leads to a cutback in military funding could be fairly significant. Russia's economy has been overheating over the past year as government spending has been ramped up. Labour shortages in Russia are now at their most extreme in decades. The central bank's lost control of inflation and interest rates have been hiked to 21%. Fiscal tightening could help to alleviate these pressures, ease inflation, and at least help to normalise conditions in Russia's bond market. So that's where we think there's potential for quite a big impact if the war does end and military spending is cut back.
I want to ask about that question of energy imports, because that's really important to Europe's economy, isn't it? But before that, just talk a bit about the Ukrainian economy. How radically would an end to fighting shift its economic outlook? Presumably, it's going to have to keep maintaining large defense budgets. And I know you've written before about the enormous costs involved in reconstruction. So how much relief are we going to get from the end to fighting?
Yeah, I think the Ukraine reconstruction timeline has been pushed back continuously as the war has continued, and it's become clear, I think, that security concerns and political stability are big constraints on private investment. An end to hostilities would be a positive. It would allow Ukraine to rebuild critical infrastructure, facilitate a recovery in economic activity, and provide relief to the public finances. The reconstruction we're talking about will be in the hundreds of billions of dollars. And financing a large part of this is likely to need to come from the private sector, with concessional support from multilateral organizations too. Some of the conversations I've had with European businesses and investors suggest that macroeconomic stability, security guarantees, and tackling corruption will be crucial to unlocking this inward investment into Ukraine. This will take time, but I think in general, there is a positive story to tell for Ukraine once the war ends. Reform momentum will take shape, including that needed for EU membership. The sovereign debt restructuring the government has recently received has been fairly generous, and Ukraine's sovereign dollar bonds have done pretty well. In recent months, the spreads of Ukrainian sovereign dollar bonds over US treasuries have fallen over 1,000 basis points on the back of the debt restructuring and on hopes for a resolution to the war in Ukraine. They're now at around 900 basis points, which is the lowest they've been since the start of the war. So I think if we do get an end to the war, with some security guarantees, and you get this optimism among foreign investors, I think the outlook does look fairly good for Ukraine.
Let's talk about Europe's economy. How does its outlook change if the fighting ends? Bearing in mind we're going to have a more isolationist US, I guess that implies greater upward pressure on European defense spending as well. If nothing else, from just the immediate threat of Russia close to Europe's borders, but also because Donald Trump, who's got this long-standing demand, European countries contribute more to NATO. So putting all that together, how does all of this translate into the European economic outlook?
Yes, I think in general, an end to the war will of course be positive for Europe, particularly for those economies in the East that were hit very hard in 2022. I think a lot will depend on how the war ends, what kind of situation Russia finds itself in, for example. European governments will probably raise defense spending, as you mentioned, and this will be one of the many pressures on European budgets. Most European governments are spending quite far below the 2% of GDP NATO target, and raising spending to at least this level, which is what Donald Trump will likely require, will need to come from higher taxes or cuts to other government expenditure, given the growing fiscal constraints in Europe. I think in terms of other implications, we wouldn't expect much in terms of cheaper energy. I think we've talked here about potential resumption of Russian gas flows to Europe. In general, I think the European market is largely lost for Russian gas exporters now, and that European politicians would be wary of the geopolitical risk associated with importing more Russian energy. So I'm not expecting big implications there in terms of Russian gas flows or commodity prices from an end to the war. I think beyond that, there might be some positive spillovers from Ukraine's reconstruction to parts of Europe, particularly firms in the manufacturing sector or the construction sector. I think those are some of the spillovers that we're looking at in terms of the impact on Europe's economy.
And a reversal of migration flows?
I think a reversal of migration flows would be a big deal. I think we've looked at this before, and there are still significant numbers of Ukrainians living in parts of Europe, particularly in Poland. A large number of those migrants have gone back, but a lot of studies out there show that once you have these big conflicts, you tend to get a permanent increase in population of those countries where migrants have fled to. So it's unlikely that we would see significant numbers going back to Ukraine. But again, I think it would depend on how this war ends, what kind of deal is struck, and if there is confidence among Ukrainians to go back to their home country. So I think, reversal of migration flows would help Ukraine and would be negative to some parts of Europe. But I think, a lot depends really on what kind of deal is struck.
Bottom line, though, putting all of this together, you're basically saying whatever happens in 2025, you see these headlines, Ukraine war to come to an end, potentially, but we're not talking about a reset to pre-February 2022. We're not going back to where we were, are we?
No, I don't think we are. I think the situation has changed fundamentally in many ways since 2022. Russia is now pushing a much more aggressive anti-Western stance. And although there may be some areas where you do see cooperation between Trump and Putin, I think in many ways this is a permanent shift in Russia's strategy away from the West and towards the likes of China. As I mentioned, I think the Western energy market for Russia is now lost. So I think there's going to be a significant reversal of trade flows between Europe and the West. And of course, we're going to see many governments raising defense spending quite considerably because Russia has now proven that it is a threat to parts of Europe. So in general, I think a lot has changed since 2022. And although we may get a resolution or some kind of agreement with the war, I think the economies of Europe and Russia are going to be fundamentally different going forward because of what's happened in the past 2 years.
That was Liam Peach on the war in Ukraine. I will post our latest note on the war on the podcast page. One issue we didn't touch on was the impact on oil prices. Our commodity team are going to be holding a drop-in. That's one of our short-form online briefings, all about the outlook for oil prices this coming Wednesday at 10 a.m. New York, 3 o'clock London. They will, of course, be discussing geopolitics and its impact on the oil price outlook. And I'll post details all about that event on the podcast page. But that's it for this week. We will be back next week with another dive into this question of tariffs and their impact on the global economy. Happy Thanksgiving to those who celebrate. And until next time, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.